The machine you never see. What if I told you that the most powerful machine on Earth doesn't build cars, doesn't mine gold, doesn't drill oil, and doesn't produce anything tangible at all? What if the most powerful machine on Earth produces something out of nothing, and the entire global economy depends on it never stopping? It doesn't sit in a factory. It isn't owned by a corporation. And yet it runs day and night, quietly, relentlessly. It prints not paper bills in the way you imagine, but digital claims, promises, obligations, debt. And here's the mystery. If debt keeps growing, if governments, corporations, and households owe more every single year, why hasn't the system collapsed? How can the world be drowning in debt and still function? Who keeps this machine running? And what happens if it ever slows down? Tonight, we're not just talking about borrowing. We're exposing the architecture of the global debt machine, how it was built, why it can't stop printing, and why its survival depends on something far more fragile than money: belief. Setting the stage. Before the machine was built. To understand the global debt machine, we have to go back to a time when money was heavy. Gold coins, silver bars, physical scarcity. For most of history, money was something you had to mine, refine, and store. If a king wanted to wage war or build monuments, he needed metal in the vaults or taxes from the people. Spending was constrained by physical limits. Then came a subtle but revolutionary shift: paper claims. Banks began issuing notes representing gold held in reserve. It was more convenient, safer, portable. But here's where the twist begins. Banks realized that not everyone would redeem their notes at the same time. So they issued more notes than they had gold. Fractional reserve banking was born. This was the first version of the machine, lending money that didn't physically exist, based on confidence that not everyone would ask for it back at once. And as long as confidence held, the system expanded, cause and effect. More lending, more economic activity, more deposits, more lending. Growth fed itself, but the machine was still limited. Gold remained the anchor. Then the 20th century arrived, and the constraints began to disappear. Origins, when debt became a policy tool. In 1913, the United States established the Federal Reserve. Other nations had similar central banks: the Bank of England, the Banque de France, later the European Central Bank. These institutions were designed to stabilize financial systems, manage liquidity, and act as lenders of last resort. But they also introduced something critical: the ability to create base money independent of gold flows. At first, currencies were still linked to gold under systems like the gold standard, and later the Bretton Woods Agreement in 1944. The US dollar became the world's reserve currency, pegged to gold at $35 per ounce. Other currencies pegged to the dollar. For a time, the system appeared stable, but there was a hidden flaw. The United States was issuing more dollars than it had gold to back them. Foreign governments began redeeming dollars for gold. The strain became unsustainable. And in 1971, President Richard Nixon closed the gold window. The dollar was no longer convertible to gold. The world shifted to fiat currency. And that was the moment the machine truly came alive. Because once money was no longer tied to a scarce commodity, debt could expand without physical limits. Governments could borrow in their own currency. Central banks could create money to buy government bonds. And deficits stopped being temporary emergencies. They became permanent features. The machine had no anchor, only confidence. The rise, how the machine learned to feed itself. From the 1970s onward, global debt began rising faster than global economic output. Why? Because debt stimulates growth, at least in the short term. When governments borrow, they spend. When corporations borrow, they invest. When households borrow, they consume. And consumption drives GDP. So policymakers faced a powerful incentive. More debt meant more growth. More growth meant higher tax revenues. Higher tax revenues made existing debt manageable. Cause and effect reinforced the cycle. Then interest rates began to fall. In the 1980s, central banks like the Federal Reserve under Paul Volcker raised rates aggressively to fight inflation. But once inflation was tamed, rates entered a long-term decline. Lower rates made borrowing cheaper. Cheaper borrowing encouraged more debt. More debt required even lower rates to remain sustainable. By the 1990s and early 2000s, the machine was accelerating. Financial innovation added fuel. Securitization, derivatives, mortgage-backed securities, credit default swaps. Debt wasn't just issued, it was packaged, sold, leveraged, and multiplied. Risk was spread across the globe, or so it seemed. But spreading risk doesn't eliminate it. It concentrates it in invisible ways. And the first real breaking point was approaching. Breaking point. 2008 and the near collapse. By 2007, household debt in the United States had reached historic highs. Housing prices soared. Banks extended mortgages to borrowers with questionable credit. These mortgages were bundled into securities and sold worldwide. The assumption was simple. Housing prices don't fall nationally. That assumption was wrong. When housing prices began declining, defaults increased. Mortgage-backed securities lost value. Banks faced massive losses. Trust evaporated. Credit markets froze, and the global debt machine, built on confidence, began to stall. This was the moment the system could have reset. Excessive debt could have been liquidated. Banks could have failed. Asset prices could have corrected dramatically. Instead, governments intervened, trillions in bailouts, emergency lending facilities, quantitative easing. Central banks created money to buy government bonds and mortgage securities. The machine didn't stop. It shifted into a higher gear. Cause and effect again. Financial collapse, government rescue, massive new debt, central bank monetization, lower interest rates, asset price recovery, even greater dependence on cheap debt. What was once extraordinary became normal. Quantitative easing was no longer an emergency tool. It became policy. The machine had proven it could survive crisis by printing more. The second shock, 2020 and unlimited expansion. If 2008 tested the system, 2020 redefined it. When the global pandemic hit, economies shut down almost overnight. Businesses closed, supply chains froze, unemployment surged. Governments responded with unprecedented fiscal stimulus. Direct payments to citizens, corporate rescue packages that expanded unemployment benefits, all financed by debt. Central banks stepped in immediately. The Federal Reserve cut rates to near zero. It launched massive asset purchases. It even began buying corporate bonds, something previously unthinkable. Other central banks followed. Balance sheets exploded. Global debt surpassed $300 trillion. The machine was no longer subtle. It was openly unlimited, and yet for a time it worked. Markets stabilized. Asset prices surged. Stock indices hit new highs. Housing markets boomed. But there was a cost. Inflation returned. After years of subdued price growth, consumer prices began rising rapidly. The hidden pressure valve had opened. When money supply expands faster than production, prices rise. And suddenly, central banks faced a dilemma. Raise rates to fight inflation and risk destabilizing the debt structure, or keep rates low and allow inflation to erode purchasing power. Either choice carried consequences. The machine had grown too large to slow easily. Fallout. The hidden costs of endless printing. When the global debt machine prints, it doesn't distribute consequences evenly. Asset owners benefit first. Stocks rise. Real estate appreciates, financial assets inflate. Those who own them see their net worth grow. Meanwhile, wages often lag behind inflation. Savings lose value. Fixed incomes struggle. Wealth inequality widens. This isn't accidental, it's structural. New money enters the system through financial channels, banks, bond markets, asset purchases. It reaches Wall Street before Main Street. Cause and effect, central bank purchases, increased liquidity, asset price inflation, wealth concentration, social tension, political polarization, more government spending, more debt issuance. The machine feeds on instability, because instability justifies intervention. Intervention requires debt. Debt requires printing, and printing sustains the machine. Meanwhile, sovereign debt levels climb. Governments roll over old bonds by issuing new ones. Debt is rarely paid down. It is refinanced continuously, perpetually. The global debt machine doesn't need to eliminate debt. It needs to maintain confidence that it can always be refinanced. That's the key, not repayment. Refinancing failed fixes. Why reform always falls short. Every few years, calls for reform grow louder. Balance budgets, debt ceilings. Fiscal responsibility, hard money. But structural incentives overpower rhetoric. If governments suddenly balanced budgets, spending would fall. Economic growth would slow. Unemployment could rise. Tax revenues would shrink. Debt to GDP ratios might worsen, not improve. If central banks stopped intervening, bond yields could spike. Debt servicing costs would surge. Financial markets could crash. Pension funds could suffer. The cure becomes politically unacceptable, so reforms are diluted. Temporary austerity gives way to renewed stimulus. Debt ceilings are raised. Monetary tightening is reversed. The machine keeps running. Not because policymakers are unaware, but because the system is path-dependent. Each layer of debt creates dependency on the next. Each crisis increases reliance on intervention. Stopping the machine risks collapse. Continuing it risks erosion, so leaders choose continuation. Gradual erosion is less visible than sudden collapse. Modern parallels the pattern. Repeats today, the signs are everywhere. Global debt as a percentage of GDP is near record highs. Interest payments are consuming larger shares of national budgets. In some advanced economies, governments spend more on interest than on defense or education. Emerging markets face even harsher realities. Borrowing in foreign currencies exposes them to exchange rate risk. When their currencies weaken, debt burdens rise. Defaults occur, the IMF programs follow. Austerity measures are imposed. Social unrest grows. In advanced economies, the mechanism is softer. Debt is denominated in domestic currency. Central banks can intervene, but the trade-off is inflation, a silent transfer of purchasing power. And yet markets remain surprisingly calm. Why? Because the belief persists. Central banks will always step in. They will lower rates. They will buy bonds. They will provide liquidity. But here's the paradox. The more they intervene, the more markets depend on intervention. The more markets depend on intervention, the harder it becomes to withdraw support. The machine becomes self-reinforcing, and the exit doors grow smaller. The core mystery: why it never stops. So we return to the central question. Why doesn't the global debt machine ever stop printing? Because stopping would expose the fragility beneath it. Modern economies are built on leverage. Corporations depend on cheap credit. Housing markets depend on mortgage availability. Governments depend on deficit financing. Financial institutions depend on government bonds as risk-free assets. If debt growth stalls, growth itself stalls. If growth stalls, defaults increase. If defaults increase, confidence collapses. So the machine must expand to preserve stability. Debt is both the fuel and the structure. It is the scaffolding holding the system upright. And because money itself is created through lending in fractional reserve systems, debt creation is money creation. To stop printing debt would be to stop creating money. And to stop creating money in a growing economy would be to trigger contraction. The machine is trapped by its own design. 3 clear takeaways. 1. Debt is the foundation, not the flaw. The global economy isn't accidentally over-leveraged. It is structurally dependent on expanding credit. Debt isn't a bug in the system. It is the system. Printing is the stabilizer and the risk. Central banks use money creation to prevent collapse. But each intervention increases long-term fragility and wealth inequality. 3. Confidence is the true currency. The machine runs not on paper or digits, but on belief. As long as people trust that debt can be refinanced and currencies retain value, the system holds. A final warning: empires rarely fall because they run out of money. They fall when confidence erodes, when citizens question the fairness of the system, when creditors doubt repayment, when inflation outpaces faith. The global debt machine has survived wars, recessions, and pandemics. It may survive many more crises, but its sustainability depends on a delicate balance between expansion and trust. If that balance breaks, the machine won't simply slow down. It will reveal how much of modern prosperity was built on promises. And promises, unlike gold, weigh nothing until they collapse. Call to action. If this deep dive reshaped how you see debt, money, and power, subscribe. Because the financial system isn't background noise. It's the invisible architecture of your future, your savings, your job, your opportunities. The global debt machine never stops printing. The real question is, now that you see it, will you understand how to live within it?